Stop right there. If you are an American with a job, you're likely making a colossal $1 million mistake right now. This is not about what you are investing in. It's about which account you are using. You are choosing the wrong retirement saving vehicle, and that decision could cost you $1 million in tax by the time you retire. Today, we break down the definitive 2025 guide to Roth IRA versus traditional 401k so you can finally beat the IRS. The fundamental difference is simple. When do you pay the tax? Traditional 401k, this is money you put in before tax. You get a tax break now. If you put in $10,000, your taxable income instantly drops by $10,000. But when you pull the money out in the retirement, the entire amount your contribution pulls all the growth is taxed as ordinary income. Roth IRA. This is money you put in. After tax, you pay the tax now. That means when you withdraw the money in retirement, even if it's growth into $1 million, it is all 100% tax free. The $1 million question you must answer is, will your tax rate be higher now or will it be higher in retirement? Getting that answer wrong is the mistake. The decision depends entirely on your current financial phase. There are two clear winners. Number one, if you are young under 35 or low to mid income under 80k, Roth IRA wins. Your income and tax rate are likely the lowest they will ever be. You pay a low tax rate now and you lock in the tax free growth forever, anticipating that your tax bracket will be much higher when you retire. Number two, if you are a high income over 150k, traditional 401k wins. You are in the high tax bracket today. Take the immediate tax deduction now to save thousand. When you retire, your income might be lower and you will withdraw the money at a lower tax rate. Don't let your current paycheck decide your future tax burden. Plan for tax rate you will have when you retire. Now let's talk about the hard numbers from the IRS for 2025. For the traditional Roth 401k, the maximum limit you can contribute is $23,000. For the Roth IRA, the individual retirement account, the maximum is significantly lower, typically around $7,000. If you are over 50, you can use catch-up contribution to put even more away. This limit changes every year, and ignoring the latest number is guaranteed way to leave money on the table. Before you even worry about Roth or traditional, you must follow the number one rule of retirement saving. Always contribute to your 401k after your company match. If your company matches 3% of your salary, that is 100% immediate guaranteed return on your investment. That is free money that you are leaving on the table if you don't take it. For most American, your contribution strategy should be step 1. Contribute to your 401k only enough to get the full company match. Step 2. Max out your Roth IRA. Step 3. Go back and max out the rest of your 401k. You cannot beat money free. What if you believe the route is better, but your income is too high to directly contribute? That's a trick the wealthy use, the backdoor route. This is illegal lawful. You contribute to a traditional IRA with the after-tax money and then immediately convert it to a Roth IRA. It's complex. It requires careful paperwork, but it allows high earners who are phased out of the Roth to still get the coveted tax-free growth. We'll cover these tricks in detail in a future video, so make sure you subscribe. The bottom line is simple. Don't leave your retirement to chance. Your tax situation today is not your tax situation tomorrow. If you are just starting out, prioritize the Roth IRA. If you are a higher earner, prioritize the traditional 401k for that immediate tax break. Now that you know the mistake, don't make it. Subscribe to PassiveMint for more US finance deep dive and learn how to secure your financial future. Click the video on your screen now.